First step is identifying the business you want to buy. So as you're having the conversation, it's really important to understand, who is giving you the money and what's like the incentive for them in that structure. What is important to the person who's letting me have this money? This is a new podcast. Please share it, like it, subscribe, all that good stuff. Hi everyone, I'm Rick Baza, and this is the Drive Podcast, where we talk about business, acquisitions, and general investing, and occasionally a little bit of real estate. So in this episode, I want to talk about the acquisition process, and specifically, how do you come up with funding for these different acquisitions you're aspiring to make? So I've been very fortunate to have 3 very different acquisitions so far, each one of which actually utilized various means of funding that I think would be helpful to go through and just give some color around what that process looks like, and hopefully some helpful advice as you get interested in moving toward that space. If you do find this information valuable, my ask of you, this is a new podcast, please share it, like it, subscribe, all that good stuff. Just help us grow the word. It would mean a lot. Obviously there's no fee for this, so that would be my ask of you. So as we get started, there's, basically a few different traditional financing options. Those are the ones I'm going to stick to. I'm not going to get too crazy and outside the box here, but, the more realistic means that 90% of potential acquisition entrepreneurs are going to be utilizing. So obviously the first and easiest is cash, straight cash, homie, as Randy Moss. I'm from New England, so that's a famous line from Randy Moss. I used to say, so basically, if you have cash, obviously cash is king. So you're going to have a lot of optionality. But there's very few of us, myself included, who have, $1 million of cash just sitting around ready to, get plopped into a new business venture. So if you have that, obviously you have a lot of different options available to you. But if you don't, you're like the normal rest of us who don't, and you're going to have to explore some other alternative means. So typically what those means are going to be are primarily you have either your debt sources or your equity sources. Now, in my case, I try as best as I can, and I hope to, this may change. It's in my personal circumstance of life right now. I have not wanted to take on investors or give up any equity. So I've primarily utilized debt sources, or I've only utilized debt sources in order to make these acquisitions happen. But for my previous life and just knowledge of others who have gone through this process, I am familiar with the equity component. So I'll touch on that as well. But when you think about debt, so basically it's, just as you would, I always use the analogy of a mortgage. So in most instances, you're borrowing money, a significant amount, to place down as your payment for the business. And there's going to be different vehicles available to you. So the most popular by far is what's called the SBA 7A loan program. So the SBA 7A loan program is a loan program that many banks around the country participate in. It would be to your benefit to speak to a bank that does a lot of these, because they can be complicated, but they don't have to be. The bank I use, they're used in the past. They don't pay me to say this by any means, but I use Live Oak Bank for mine. They are the largest SBA 7A lender in the country. So they had an awesome process. A lot of people say oh my God, it's getting a colonoscopy, it's horrible. I did not feel that way at all. Everything they asked for was stuff that I would have fully expected them to ask for, financials, tax returns, credit history, all of that. Nothing was a surprise, and they were very smooth through their process. So I had a great experience with them, but there are plenty of others out there. And anyway, so you want a lender who's done this before, been there, done that. I would not recommend just going with someone who said, yeah, they've done a couple of them. From what I've heard, you may be in for a really bad headache, and you may even lose your deal because of it, which would be the worst case scenario. So once you've identified, though, your lender, as you can imagine, let me back up, because obviously the first step is identifying the business you want to buy, right? And at that point, you've identified the business. You're going through whether it's different networking channels, so CPAs, lawyers. Maybe you're just going on the classic bizbuysell.com website to look up different businesses that are available. But whatever it is, you've identified the business you want. You've gone through and talked to the seller, and you've come to the conclusion, hey, I've seen the financials. I like what it is. I want to make this acquisition happen. So at that point, you're now talking to the bank, and you really at that stage of the decision-making process, you're getting interviewed essentially. Why are they going to lend to you? Do you have a business plan in place? Are you someone that they are going to think, that has a chance of successfully taking this over and operating it? At the end of the day, a big thing to know on the debt side is they don't necessarily care as much of your growth path because they're not participating in the upside of the growth. What they care about as a lender is making sure that those debt payments are going to be paid back on a regular basis. So this is one of the interesting things where, on Shark Tank, for example, you probably think of how they're thinking of all this explosive growth and how am I going to capture upside later. That's more on the equity side. The debt side doesn't care about that as much. What they care about is how risky is this that I'm going to make my return back the money that I let them borrow, plus my interest along the way. Like that is their primary and only concern for the most part. So all your growth plans and everything, sweet. Yeah, of course they want to see that you have a business plan in place, but mostly they want to make sure, am I going to get my money back? That's their business model, right? So as you're having the conversation, it's really important to understand, who is giving you the money and what's like the incentive for them in that structure. So in debt structure, it's protection of capital. Equity, that's a different conversation. That may be higher upside opportunity, and we'll talk about that a little bit. So as you're going through the bank process, they're asking you for your information. Now, there may be stipulations. So like in my first acquisition that I did, actually even obtain an SBA 7A loan because I did not have a plumbing license. And obviously a key risk to the bank, going back to look at it from their perspective, how am I going to lend money to someone who doesn't even have a license to operate this business? Right? That's a natural risk that I understandably could say, well, yeah, no way I'm getting that loan. So in that case, we had to come up with alternative means, which then introduced the concept of something like either seller financing or potentially having to take on investors or things like that. So that's when you have to go into a concept I'll describe now is called seller financing, which is also very popular. And this can be really attractive to the sellers, but understand, put it from what is their lens. You're now introducing another risk to the process, right? So if you're asking the seller to basically be your bank, that's where the seller is saying, hey, I'll allow you to basically make, and I'm just going to make up a number, but let's say your purchase is for $1 million, and the seller says, I'm going to finance 500,000 of that. Well, you're now asking them to basically trust that you're going to make those $500,000 worth of payments plus interest over time, and that they're going to have confidence they're going to get that, right? Whereas if you would just gotten that full loan from the SBA and given them the $1 million, they don't have any risk of that anymore, right? The seller has now gotten their money, they're happy. So by introducing seller financing, you are introducing a new risk to the seller, and you may have to introduce other potential upside to offset that risk. So maybe it's in the terms of a better rate. Maybe it's in the terms of a better payback period. So maybe instead of 10 years, it's 5 years. Maybe it's in terms of adding some upside potential where, hey, if we are able to successfully execute my plan, I can give you more money later. So there's a down the road opportunity for them. So in any event, you kind of get the sense, right? So you're thinking about it from what is important to the person who's letting me have this money, right? So from the bank's perspective, they need their return on capital. From the seller's perspective, they obviously want the return on capital too, but now they have extra risks that you're going to have to figure out a way to offset. Those are two of the more common debt approaches that would be there. Now, in the case with the seller financing, I think that the analogy of the mortgage payment works perfectly because you're able to say, hey, I'm going to give you a big chunk of money down, which, again, go back to what do you think is important for the seller? So they probably have still a loan. Maybe they have their own SBA loan that they still need to pay off. They may have vehicle loans, like in our business, if it's a lot of vehicles from their operations, they may have leases or loans outstanding if they acquired those vehicles that they have to pay off. They may have equipment loans. You get the point. So there's potentially debt that they need to clear. So in a lot of cases, you might come to them and say, oh, well, let's go back to our $1 million example. I'm going to buy your business for $1 million. I'm going to give you $200,000 down, and I'm going to ask you to seller finance 80%. Well, if they're sitting on $400,000 of debt already that they need to clear, it's an impractical starting point, right? They're like, no, this doesn't make any sense. And if anything, even if you said, I'll give you $400,000 down, all you did was wipe out their debt. They still probably, in the scheme of things, don't feel like that was worth their interest, right? So you're really trying to figure out, how are you coming to terms with them that's going to make sense for what they need to accomplish, but also is going to put you in a position to succeed. And that there may not be a way to square that. It might be trying to put a round peg into a square hole and it doesn't work. And in that case, you have to walk away. But at least you're going into it understanding, what the different dynamics are. The attractive thing about the seller financing can be, for the seller's advantage, spreading out that tax liability. So obviously if they get all the money up front, right, if you purchase it, well, they're going to owe taxes on that entire amount. Whereas if you're paying them off in installments, that tax can be spread out through that installment payment. So that can be an attractive way to position it to the seller of saying, hey, a lot of people are used to having their draw from the business anyways on typically like a monthly or quarterly basis. So it could be kind of keeping up with the normalcy of how they've operated and lived their lives for the last however many years they've been running the business. So it could be attractive to say, hey, rather than just getting this one huge lump sum of money that now, especially in today's market environment, you're going to have to turn around and probably put in the stock market, which may terrify a lot of sellers to begin with, because most of business owners are already a little skeptical of the stock market because they're used to operating something that they've had full control over. Now you're telling them, go put this money in something that moves like a roller coaster, whether they, execute properly on their business or not, right? So there's already an initial skepticism. But if they get all that money up front, now they're going to turn around and, where are they most likely going to put it? And, they're not probably going to put it all in a single real estate property. So oftentimes it's going to be the stock market, and that may scare them too. So they actually may have more trust in that if you're able to be a, competent buyer, that you're likely actually going to be able to continue to make those payments to them on the process. So if you can add an attractive interest rate to it, it actually may be to their liking where they say, I'm going to get a big pile of money up front, clear off the debts that I have, maybe have a little bit extra just to put in the bank and have some cushion. And then I'm going to continue to get my regular paycheck, or what, feels like my paycheck. It's really your payments to them on an ongoing basis over time. That could be really compelling. It could not, but I mean, it's definitely an avenue worth exploring to see if that's something that they're interested in. So you have options is the point. And in that case, the seller financing can be particularly attractive because it definitely sets you up for a nice win-win with the seller, in that example. So those are the more common paths. You have your full SBA loan. There's a bunch of rules that I won't go into on how the SBA works, but one of the important ones is for typically your initial acquisition, you do have some sort of down payment required with it. Now, what's exciting is once you're in the arena and in the game, if you will, the SBA then actually allows you to do what are called expansion acquisitions, which I have since done. And in some cases, you can do those with 0% down. So that allows you a lot more flexibility from a cash standpoint to potentially execute on these opportunities as they present themselves. So there is definitely a benefit once you're in the game, so to speak. The game is tailored to then support you a little bit. Getting in can be a little bit more of a burden, but it's I kind of describe it as analogous to your typical home mortgage where you got your down payment, the bank will lend you the difference. Now, again, there's some things where they will allow certain seller financing, and there's various rules that I think is outside the scope of this video, but just understand the gist of it is commonly the 7A is used as an entry point loan to get into new businesses. And if for some reason you have something like in my circumstance where the licensing is required and you can't access that loan, you may be able to explore some additional opportunities directly via the seller, but understand that you are now adding a burden to them that you're going to have to overcome through some other measure. So those are the more common options on the debt side. If we move over to the equity side, that is when you are taking on investors. So you're giving up a part of the ownership in your company to basically have access to their capital, their wisdom, whatever they're bringing to the table. It could be various things. I have not chosen to go that route at this point. I think I'm hard to probably be at this phase of my career. I don't think I would do well necessarily answering to people. So on the other side, you have your equity investors, and these are people who are either lending their money, their time, their wisdom, whatever there may be, but they're basically contributing in some way to the company, in which case you are exchanging a percentage of the ownership for that. Now, again, I haven't gone that direction, but that becomes a popular dynamic, especially as you're fueling significant growth. Maybe taking on a private equity partner, a family office, some sort of strategic investor, where they're coming in and basically helping you springboard to the next phase of business is really common. You may just have friends and family, you may have partners, people who are going to help you accumulate the money for some reason if you couldn't get the debt to work. Maybe you had reservations about the debt because there's personal guarantees that can be involved with those SBA loans. Maybe, your significant other or someone close to you wasn't willing to take that on, or you just personally felt uncomfortable with it. I would say if you feel uncomfortable with the PGs, you're probably going to have to get comfortable with them because pretty much have to PG a lot of stuff when you're in the business world. But that is one of the reasons that a lot of people will end up taking on some equity investors. It can be a phenomenal path. Again, I haven't personally used that at this point, but I know a lot of people who have and have been, very happy with the decision. And it's something that I'm kind of always contemplating and evaluating, when would be the right time, if any. And that's just a decision tree you typically are having to work through. Can I meet my objectives from the debt vehicles that are available to me and still feel comfortable from a cash flow standpoint and, making sure my payments are covered and I'm not putting the company at undue risk by taking on too much debt versus, do I want to have equity investors who I'm answering to, that are getting a return on the company's profits, all of that type of stuff. So, and that's just a decision tree you're kind of constantly working through. But those are two of the common frameworks. In either event, no matter which way you're going, I think it's very helpful to understand, going back to it, what are the incentives of the person who are lending you the money? Like, what do they care about? And so obviously, as I said before, with debt, getting their money back and making sure they're getting their payments. With equity, it may be a bit of a different thing. Not to say they don't care about getting their money back, but typically on the equity side, it's more about the upside opportunity later. That could introduce other challenges that you may not be aware of. So, they may basically want or / require you to then exit that business down the road. So you may be thinking, hey, I have this infinite time period in mind. But if your investor is saying, well, hey, how am I getting my money back with a return? Year 5, year 7, they may be saying, hey, we need you to go bring this thing to market and try to sell it so that you can get your payments, from the sale and give them back to your investors. So just be careful. It could open up some dynamics for things that maybe you're not thinking about operationally that are really important as you kind of get this going and really funding. Because a lot of times people will feel like they're backed into a corner and, I just have to bring people on, and they don't really know that you may be able to explore these debt channels first. But ultimately, it's pros and cons of each, and each one has, there's some sort of upside or downside associated with it, and it's really just whatever is better for you at the time in business that you're at, not necessarily one being better than the other. So those are pretty common approaches. And then obviously, if once you're in the arena, in my opinion, one of the primary goals is to utilize cash flow to continue to reinvest and have opportunities to do acquisitions through cash flow. So with our Zoom Drain franchise, that's one of the things we were able to do is actually take money from the business and then reinvest it back in to help expand that. And I think that's exciting because that's where you're, ideally, that's the goal of the business, right, is to be able to continue to grow. And as you're growing, you're expanding opportunities for your employees and all that comes with that. And so we're in the phase of life where it's really reinvest heavy into the business and make sure that we're continuing to expand the opportunities for the team. And we'll continue to do that. So we're really looking at a mixture right now of the two opportunity sets, which are either reinvesting from the business profits or growth that we're seeing, or utilizing debt channels in an effective way where we're not over leveraging ourselves and putting the company at risk. And then who knows, down the road maybe there's an opportunity for investors, but at this point we're not there yet. So I hope that kind of helps in the decision tree process as you're going through different opportunities that are available to you. If you have any questions, please drop them in the comments. You can also shoot me a message directly at Rick Vaza on Twitter. If you found this valuable, which I hope you did, please share it, like it, subscribe, all that good stuff. Help us grow the word. It's a new podcast. We'd really appreciate it. And thanks for tuning in.